everybody here to Azure Capital's dinner mingling with clients. It's interesting because I will have... Oh, do you need me to move the seat for you?
Sorry.
No, I was going to move the seat away for you. No, this time round we decided, last July, we had this massive gathering, and we didn't think that was good enough for all of you because many of you are clients. We didn't have the me time, the we time together with clients. It was mixed with some of the friends from industries and all. So we decided to split the session. Today, it's just specially for the clients of Azure Capital. Many of you have invested in our funds, particularly Azure Light Fund. So I'd like to thank you for your support. And I promise a cozy space, a cozy time with many of you. And this is it, right? So tomorrow, there'll be another session. But the session will be a lot, like I said, bigger, the crowd. And then so that there will not be that much personal attention. I like something like this. Cozy with the people that we like. Not say that tomorrow the people we don't like, right? So, if you were to see what has been happening over in Azure Capital, if you read about us in the media, whether is it TV, radio, or the newspapers, right? Many of you would think that we are singularly focused on looking at stocks, looking at markets, the economy, right? Because practically 100% of the reports are on those particular niches. But I'd like to tell you that we have broadened significantly since the founding of Azure Capital in 2015. We have also not only broadened in terms of products, but also our bench strength. These right now, but today I know some of you. Sorry? Equity rocks. Okay. Yes. So we were looking at equities for quite a few years until the next product came on. We continue to focus a lot of attention on that. But today we will not, I know I will disappoint some people. I am not going to talk about the market outlook, but here's a plug. Every Thursday, rain or shine, 5:40 p.m. live on Money FM, you hear either David or me talking about market, sharing our views for 15 minutes. So if you want to hear our market views, our stock market views, you can get it there. I also want to introduce some of the people, I wouldn't say behind the scenes, but some of the very important people within Azure Capital that have added onto our bench strength. Chris Cheng. Chris, he started off as an investor just like many of you, but he's a little bit more kaypoh. He'll come and talk to me, bug me about ideas, and I realized he is a great strategic thinker. I really appreciated many of his ideas, and it allows us to blossom. And one of the reasons why we have this platform right now, I think, is a large part due to him. I'm very, very thankful, and I appreciate his wisdom on properties, bonds, fixed income, life in general. So I'm proud to call him. He's actually my full-time partner and a part-time farmer. During durian season, he goes up to his plantation in Johor, right? And then he goes whack the durians. And he has graciously invited all investors, during durian season, to go up and makan together with him. But here's a disclaimer. Just this year, end of August to beginning of October, there's a blackout season. Because he and I will be busy at home mugging for our PSLE exams. So don't disturb us during that period of time. Other times can. Other times he'll bring you over to Johor to enjoy durians. And I've also got this sustainability expert. He was concentrated and he championed sustainability before it became a buzzword. He's a man of multi-hyphenates. He's Rhodes Scholar, 3-time Olympian, swim coach. He was our Singapore swimming team captain. And no, I am not talking about Joseph Schooling. This guy is Desmond Koh. Des. I think many guys and also women will recognize him without his facial hair. And right, so he was one of the most popular swimmers back in the late 80s, early 1990s. And I've also got one other person, Dennis Ng. Dennis here you are. He's a very, very seasoned trader and fund manager, so I was glad for him to join me. He has about 30 years of experience. We experimented with the VCC system. We were one of the pioneers to start a fund under VCC. And despite his age, he looks, I mean, he's very experienced looking, right, and very patrician. But he's probably the most forward-looking, and one of his fortes is being able to break up very complex issues into simple parts. And I guess there'll be no better person to explain cryptos as well as digital assets than Dennis to all of us who are not, who are in the Gen X boomer kind of generation. So Dennis, okay, you're gonna start off.
Okay. Thank you, Terence, for the kind introduction. Terence, thank you because I'm glad that I joined the Azure team and also to learn from them in the traditional equity space. Through Azure, I've also met various people in doing various aspects of fund management, like Kramjit in property. I mean, he's renowned in Singapore for being the en bloc king, right? So really a great pleasure to have him here with us. Well, so digital assets are kind of, I mean, you look at me at my age, right? What do I know about digital assets? I mean, there are so many younger people here who probably are more experienced and more knowledgeable about the crypto space. I was fortunate in about 2021 to dabble into the crypto space personally. And my God, it's crazy because there's so much terminology that was so new to me, right? I mean, we talk about traditional equities, whatever instruments, we talk about transactional fees, right? In the crypto space, they call it gas fees. It's like, what's gas fees, right? And then we talk about blockchain, right? Having decentralized ledgers to post your transaction. And of course, it is something very useful. I think a lot of people are looking to explore how to make use of the blockchain, right, in the traditional world. Of course, I think one of the best use cases is that being decentralized ledger, right, you can probably find it very difficult to hack into the blockchain. So of course we have heard of many cases where a lot of crypto exchanges have been hacked, but the blue chip of all this crypto, Bitcoin, the Bitcoin blockchain has never been hacked, right? And that's the ingenuity of the person who built up this Bitcoin blockchain, right? But the use case is my analogy for the crypto and the blockchain space. Think back about those who were able to experience the dot-com era, right? So there are a lot of companies that are trying to leverage on the internet to build a business model. So now, of course, we have successful companies. We talk about Amazon, we talk about Facebook, that able to leverage on the internet and build up a big business empire. So who is the next company? What are the next companies that are able to leverage on the blockchain to make a successful business case out of the blockchain? And this is where I think there's a lot of opportunities. I think in the next decade or even more, there will see new companies emerging that are able to build business cases out of the blockchain, right? So again, blockchain, as I said, if you think about it, there are a lot, I mean, in the traditional equity space, you talk about companies issuing shares to raise capital, and that gives you ownership into the company, right? In the crypto space, digital asset space, basically you own tokens that's being issued by the Web3 or the blockchain company. So these tokens basically also represent equity and value for you going forward into the company if you invest, right? But besides that, the beauty about the digital asset space also is the volatility, because right now there are a lot of players, trying to make a space, a mark for themselves into the digital asset space. So there's a lot of volatility in the tokens that's being issued. So of course, if you are able to identify the right company, identify the right token, right, there's a lot of opportunity on the upside. Not only that, the more blue chip tokens like the Bitcoin, the Ethereum, these are probably two of the top crypto currencies, right? There are a lot of right now option products being generated, and returns on these option products, because of the volatility, are much higher than what can be offered from the traditional product space. I mean, we have heard of when the Lehman crisis, we have things like accumulators, right, where you buy into equity of let's say American Express Bank, right? You buy with an option at $10, and then you keep on buying, but at the end, if it crashes, you get to keep all the stock at very high prices. That could actually disrupt your planning. But the crypto space, similarly, because of the volatility, if you know how to identify the risk, right, there's a lot of opportunity for yield generating strategies, right? So with this fund, what we are trying to do is, because a lot of people are not familiar with this digital asset space, we identified three areas or three pillars that we would like to invest in this space. One is, of course, the traditional, like what we call venture investments, right? Trying to identify startups, as I said, in the blockchain and the Web3 space. And by investing enough sufficiently over a number of startups, right, we hope that we will get a decent return on at least some of these investments that we make. So the whole fund is structured such that 20% of the fund is allocated towards startups, right? And then the other 80%, 40%, we will go with yield generating strategies. So as I said, there's a lot of option opportunities available. I was a trader. I used to be a chief trader for two banks, Arab Banking Corporation and Bank of Montreal in Singapore. So I'm quite familiar with option strategies and how to make the best use of them. So 40% of the fund is allocated to such strategies. But not only that, if you know about Bitcoin, people buy machines to mine the Bitcoin, right? And get basically free currency when you get the Bitcoin, and you wait for the Bitcoin to appreciate in value. Again, there are other currencies like Ethereum, where instead of mining, we call what we call staking, right? So you actually put your money in and you participate in validating the transactions that is happening in the Ethereum space, right? So we are also looking at participating in staking as part of our yield generating strategies. And lastly, the 40%, we will look at, of course, investing into blue chip cryptos. Like for example, Bitcoin right now, traditionally is supposed to be a non-inflationary token, right? Because there's only a certain amount of Bitcoin that will be issued, right? So every 4 years, Bitcoin goes through a halving. So for the miner, just imagine, right, if you were given a reward of $10 initially, right? And because now the Bitcoin has been halved, you're only getting $5. So for this, $5, you need to be rewarded twice in order to make the same $10. So that's why Bitcoin over time is expected to go up. Right. So you can see there are cycles in the Bitcoin, just like any traditional commodity. There are what we call crypto winters, right? And of course, crypto bull runs and all that. So maybe I'm boring you. I see a lot of blank faces. So I try to end here. There are a lot of more terminologies maybe you're not familiar with, but I welcome anyone who wants to learn more about Bitcoin to approach me. I'm also very fortunate. A good friend of mine, Professor Jerry Hayes from Indiana University, is here. He's a veteran. He brings in students from Indiana University to learn about Singapore every year. So I was from Indiana University as well, so I'm an alumni of the university. So he is also a veteran in the crypto space and also into investing into startups in the US. So we also hope that eventually, through the Azure ecosystem, we are able to tap onto his network in the US and invest into US startups. But this will be more the traditional companies. So thank you everyone for the time, and I hope that you will continue to enjoy your presence here and the food. Thank you.
In Singapore has been smashed over the last 5-6 years. You know, every time your highest per square foot, the largest plot, and all these things have been smashed. But there is one record that still stands to today. That's since 2007. The largest en bloc sale in Singapore. 1.338 billion. Did I get it right, Karamjit? 1.338 billion. Yes, Farrakot. And now it's transformed into D. Leiden. Karamjit, but the amazing part about Karamjit Singh was that he did it in his own little shop. And when I mean little shop, I really mean little. I think he has like just a few staff, maybe 10, 15 guys, versus he was vying against the large Goliaths in the industry, the JLLs and all, right? So after that, after he successfully sold or got this en bloc deal done, JLL came in. They cannot stand all these little guys, right? So they started to snap it up and brought him into the fold. Then that was in early 2010s, 2012, 2016, he decided to come out again. And right now, Karamjit runs ShowSuite, which I think I'll ask him a little bit about it. This is going to be a fireside chat. ShowSuite as well as the LASA, which stands for Development and Land Sales. Did I get it right? Karamjit, hi. Okay, now put your hands. Welcome, Karamjit Singh.
It's one of those cases where we just happen to be lucky in the right place, right time. No magic to it. But again, yeah, we're very fortunate to have done that. And I've got my colleague here who was with me during our Farrakot days, Credo days, JLL days, and now Dilasa. So I've been told that this is a community of super high net worth individuals. So a hot topic is Singapore real estate. So I'll try my best to cover as much grounds as possible. And naturally with that, I'm quite sure there will be a lot of GCBs, so I'll try to cover some GCBs, is what's happening in the market, if that's okay. One of the most burning questions that most people tend to ask is, why is Singapore's real estate prices so high? Why is it so high, and how is that even sustainable when you've got structural issues, you've got inflation catching on, SMEs are not doing super well, is it bubbly, is it about to pierce, and why bother investing in Singapore's real estate? So that's a fundamental question. And here, this discussion is not to promote investment in Singapore, but it's just to give you a general perspective towards what's happening in the market. For that purpose, let's step out and look at the big picture of what's happening. So Singapore is an amazing success story, as we all know. The very fact that we've emerged from almost a third world to a top-rate first world country, that says a lot. That's number one. Population obviously has been on the rise, but most importantly is household wealth. It's a staggering figure when you think about it. Just to put things in perspective, over the last 10 years, population has risen by 10%, but household wealth has risen in the last 10 years by almost 100%. That's according to the Department of Statistics. So that in itself is huge. Why? Multiple factors. Our forced savings policies around CPF, the HDB policies ensures that every Singaporean household is a property owner, and which is distinctly different from many, many countries and markets, where 90+% of Singaporeans actually own our own homes, which is a phenomenal thing. And plus, how households benefit from HDB grants, it's effectively putting pocket money into households' pocket. So when things rise, everybody benefits. So it's like high tides brings all the boats up. So on one hand, you have that. On one hand, you have a factor about density, how densely populated we are. When you talk about population density, you would think about, third world countries, whether it's Bangladesh or any others. But effectively, Singapore's population density is among the top 5 in the world. Why? Because we all live in high-rise. So in relation to the square footage of our island, we have a disproportionate number of human beings. So when you have that, compounded by the fact that we've got super wealthy and so much of savings that's exponentially rising, it does point to a very sound, stable, sustainable, high real estate market that we have here. Separate from that, we've got immigration and policies that generally attract super high net worth individuals to come set up base, set up family offices by offering citizenship, PRs or so. That adds to the density of high net worth individuals. Singapore's is probably the 4th largest density of millionaires that has surpassed traditional big economies like London, France, Geneva, Beijing, Shanghai. And that in my mind is another staggering statistics. So number 1 is New York, then the Bay Area, 3rd is Tokyo, and 4th is Singapore. So in relation to the size of the population, it's amazing. So against all this backdrop, we do feel Singapore's real estate will continue to be an expensive market relative to many other markets. But it's not necessarily going to be plain sailing, throughout. We would need to withstand the ups and downs. We have our pressure points, we have our headwinds, like many other markets in relation to interest rates. And sometimes there are bursts of oversupply, and naturally that will bring prices down. We've got cooling measures that changes the dynamics of certain segments, like for example, what high ABSDs have done towards effectively killing off and bringing down the luxury end of the apartments market. So each of them have different effects to whatever that's happening at the macro level. So that's just to kind of give you a quick summary, some context towards why the burning is the answer to perhaps the burning question about the high values of Singapore's housing market. Now moving on to 5 key sectors within the residential market. So I'll start off with the GCB market. GCB is basically, as you would most of you all know, it's good class bungalows where you've got a minimum plot size of 15,000 square feet. There are only about 2,800 GCB plots in Singapore. Only 2,800. Against a total housing stock of about 1.6 million, almost 1.6 million. So you can imagine how tiny GCBs represent as a housing form in Singapore. And there's no new supply or negligible new supply because no one is able to manufacture new GCBs because we've got that much limited land mass. Against that backdrop, you've got wealth that's just riding high and high. So when you have demand, wealth, underpinning the demand for GCBs, no new supplies, you can imagine that GCBs is one sector that we will always be bullish about. Over the last 10 years, GCBs has been one of the best performers amongst the residential pockets. It has risen by almost 40%, 38% over the last 10 years. So that's quite consistent growth. So that's GCBs. Next comes all landed outside GCB. So that will be small detached, semi-Ds, terraces or so. So again, I spoke about 1.6 million dwelling units. Landed is about 75,000 dwelling units. So that's semi-Ds, terraces, and small detached houses. Over the last 10 years, the new supply of landed is also negligible, only 3% over the last 10 years. So not much of new supply. So no surprise that over the last 10 years, landed has gone up by 32%. A strong market, sub-market, again underpinned by wealth growth, population growth, and negligible new supply. It's now going through a consolidation phase. Whenever you have the market surging up in a short span of time, it does need to take some breather, which is where it is right now. But long-term trend will naturally be positive. Again, by no means cheap market, but it will never be a cheap market. So that's landed. Third, luxury end of the market. Badly battered by high ABSDs to a point where foreigners' demand has been eradicated. So landed, luxury end of the market has come off quite a bit. In exchange, mass market private condominiums has been the absolute gangbusters, the biggest performer over the last 10 years. So if GCBs went up 38%, landed went up 32%, mass market went up 46%. So it just goes to show that how different distinct sectors or subsectors have performed and performed differently for different factors. So that's kind of a quick synopsis of where we are, where the market is trending. Happy to take any questions.
Do you have any questions? What about other types of investment properties other than residential?
So again, so the capital markets business is all about buying assets for income. Singapore has never been a high yielding market. At most you get 2.5 to anywhere to 4% in its rental yield. But why do people still invest? Is because of its capital growth, and that has proven time and time again to be successful. Not in all cases, especially in the leasehold sectors. Right now, the headwinds are in the form of high interest rates, that to a point where it leads to a negative carry. And there are some sectors of the market where rent rates have plateaued or dropped. So that has created a divide between what sellers will ask for, what buyers can afford to pay. So the segment of the market that's perhaps doing better amongst the office, industrial, retail is perhaps the hospitality sector. So whether it's the co-living, service apartment or hotels. Still, it's one of those segments where I think people are bullish that tourist arrivals will continue to underpin demand for it. And again, it's a segment of the market that foreigners are allowed to buy, and it's not one of those sectors that have high friction in the form of high ABSDs.
Thanks. Any other questions? Yes.
What's your view of the conservation program?
So conservation assets have done extremely well. Again, backed by no new supply. It's only that many limited assets. Most of them have commercial zoning, which allows foreigners to be able to buy. So it makes them more liquid, more tradable, to a point that capital values have risen so much that there's not much of a yield anymore, to a point that capital values and rentals, there's a huge divide, where most other assets generate 3% yield, some conservation of shop houses generate 1%, 1.5%. So that, but why do investors still buy? Is because it gives them a sense, a tangible sense of owning land and a pretty building. So it's a different perspective towards investment. So it's more of a trading mentality, and sometimes it's an emotional spin towards it. So if it's driven by financial or rental returns, no, that's where it's weak. But it's tradable because of no friction pertaining to stamp duties or foreign restrictions. And that's the reason why it's done very well.
Yes. Is there
Future for en bloc.
Yeah, and then what kind of properties do we look for to
Yeah.
invest in en bloc?
So in the past, most of the successful en blocs were conventional apartments, condominiums, old, where there was a mismatch between the values of old apartments and brand new apartments, and that gives rise to an en bloc arbitrage that can be capitalized on, where apartment owners can sell for a profit, and yet the developer still has enough of a margin to buy them out and sell it and trade on it. Most of those that were successful in the past were successful because of unutilized plot ratios, where the old developments were underbuilt in relation to its potential, governed by the master plan today. That generation of developments has come off substantially because they've been sold along the years. The only ones that are left standing are those massive size en blocs, huge, 1,000 over units or 600 over units, that when they get redeveloped, they will give rise to about 2,000 apartments. Now, the current laws do not favor massive en blocs because developers are told that whatever land that you buy, you've got to buy, build, and sell in 5 years, irrespective of the scale. Whether they've got 5 apartments to sell, 500 or 5,000, it's still 5 years. So it puts those large en blocs in a huge disadvantage, which is why none of them have been successful. There are other factors that I won't get into, but simply put, perhaps the only pocket of opportunity would be mixed use, old development. Mixed use would be where there are components of apartments, components of retail, where it's not in its best condition and it's waiting for it to be redeveloped. Perhaps you could find some arbitrage. But to be honest, there have been a lot of people looking for en bloc opportunities, but it hasn't been easy because the success ratio has come off substantially. So if you're buying solely for en bloc, it's not going to be a sure shot strategy. So you've got to take a view that if it doesn't happen, an en bloc doesn't happen, you can still sustain and it's still underpinned by rental growth, then that's fine. Office market?
Question on the offices and A grade of.
So the CBD market for offices is changing, and one of the key changes is the government is driving decentralization. They want more offices to be located outside CBDs, so which is why they're trying to promote redevelopment of old office buildings into non-office uses, mixed use, hospitality, service apartment, or apartments. So which means that the stock of offices will dwindle. They have been releasing land for grade A office buildings, and whenever they do take shape and get completed, the take-up rates are not bad. Why? Because there's a new wave of corporate tenants who specifically are mandated to move into those office buildings that meet certain environmental standards, because they can't go into the old buildings anymore. So those corporate tenants will gravitate towards the brand new office building, the Grade A office building. But it's going through some structural changes because of all the redevelopment and sometimes the displacement of some space and the decentralization. Work from home as a phenomena has disrupted demand for offices, but not in a mega way, not like in many other cities. Why in Singapore is mild a disruption is because our homes are a majority of the homes are relatively small. Commute to CBD or office spaces is not that much of a pain point compared to many other markets where commute takes them 1.5 hours, back and forth. So work from home has shrunk demand, so companies can afford to renew leases for the same operation but with less footprint. So when you aggregate all of that, demand has gone down. So there's always been a flight towards brand new and good quality, but those sitting below Grade A tends to suffer. Grade B, Grade C tend to suffer.
Okay. If there's no other questions, I think Karamjit has to run. You have to run, right? Any questions, you have my email, just hit me, and I will forward it over to Karamjit. Okay? Thank you so much.
Thank you very much. Thank you.
I'm still under a quiet period, right? But once the lawyers allow me to say it, rest assured you'll be the first one to know, right? There's going to be a lot of updates coming through the shareholder letters and what exactly is going to be happening in the coming months. So I guess let me just rewind a bit now and just to say, first of all, thank you so much for your support of the Azure Light Fund. Thank you so much for your support of the Light journey thus far. Many exciting news coming, but I'm not allowed to say it yet. So what can I talk about, right? So I think maybe let's go back to some guiding principles that excite me and Terence and the Azure Light Fund, right? So one of the things that I can assure all of you is that all the business expansion news that we are about to announce, hint, right, will be guided by these following principles, right? The first is it has to be a large addressable market, right? You know that, right? I'm not going to work for free, right? It's hard work, right? So it has to be meaningful in terms of size, right? It has to be a large addressable market. The second guiding principle is it has to be safe, right? Same thing here. You all know in all my conversation with you, right? I keep repeating this over and over again, that even though I look young on the outside, on the inside, I'm extremely old. I'm very old school, right? I only have the veneer of a tech person, right? But inside me, I'm closer to my akong, right? In terms of how I approach business, right? That's why I always say that I must apologize if the business looks boring, right? It's not growth at all costs like some of the tech companies, but we all know they're paying the price for it now in the last 18 months because the whole funding crunch, right, has seized up in the whole global markets, right? And you'll hear a lot more bad news coming from them, but not us, right? We are boring, but we're stable and we're safe. And we want to keep that going in all the new industries that we expand into, right? So I think that's the second guiding principle, just to repeat that again, right? And the third thing, right, which I need to highlight to all of you as well, is we never, ever, ever promise the highest returns or yields in the land. But we do commit to stability. So I think that's another thing I need to repeat, to keep constantly emphasizing that we are a good spot in your portfolio management. Obviously, you're never ever going to concentrate 100% in fixed deposit or 100% in high-risk stocks, right? There must be a spectrum. So we have always positioned ourselves somewhere in that spectrum, hopefully closer to the fixed deposit side, because we do see ourselves as safe spectrum, right, towards the fixed deposit side, although we can never guarantee it like a fixed deposit. So I think these are the three guiding principles that will drive a lot of the strategic decisions and industries we're about to expand into, right? So once again, I just want to tell you that I'm actually so excited to be announcing to you what is coming, but I have to bite my lip and hold myself back, right? Then you might ask, what are you doing here, Dennis? I'm telling you why I'm here, right? It's because of Terence. He has been so supportive as a partner. He said, Dennis, you must at least show up and tell everyone that, tell them that there's great news coming, and then tell them, but you cannot tell them, right? So that's the best I can do now, right? Maybe Terence would love to grill me a bit, right, on what is to come, and I'll try my best, because if he asks me, it's easier for me to answer, right? If I say it voluntarily, it's harder, right? So, wing, okay?
Dennis and I have known each other for almost 40 years already. We were primary school mates together. I know some of you who attended the talk last year would know that, we were primary school mates, right? Go back a long, long way.
That is where there's a big difference. I look 40 years older, he looks the same.
He's always 2 heads taller than me. Never changed that one. Okay, can you let us know a little bit, because the first line of business is with advancing commissions to the property agents. Can you let us know about the market right now? How big is it? What's our share?
Okay, very good question. So this will be part of the update, but this one I'm allowed to tell you. So today, we have actually taken all top 5 of the real estate agencies in Singapore, right? So ERA, Propnex, Orange T, Huttons, and SRI. Right? These are the 5 exclusive real estate agency contracts that we have today. But having said that, I also need to be very upfront. We haven't taken every single agent yet. So due to the so-called funding crunch last year, brought about that, I won't repeat it, the macro events of last year, every tech company, including ourselves, no matter how safe we are, we decided to cut back on our marketing, cut back on our spend, right? Basically make a drive towards profitability. So as a result of that, one hint I can give you is that it's actually getting increasingly likely that the hard work is about to pay off, that for the full year, Light is going to be profitable. So that's one good news, especially for those of you who are also on the equity side. But in return, right, because we didn't spend so much, we were not able to aggressively go and capture every single agent out there, right? We have to cut back on a lot of our marketing, just let word of mouth take its natural route, right? So we are still onboarding more and more agents with every passing month, just not as fast as and aggressive as it would have been if we had spent the money. So I think on hindsight, that was still the right move to make. Now the question is, going to the second half, if we know that we're actually in a much stronger financial position, are we going to actually ramp up again, right? Be aggressive on the cost side, right? That's another business decision. To be honest, we haven't made a decision yet, but that is something that will be on our minds. The other strategy is that to expand to new markets, right? So let me just share with you some of our findings, given that we have been in the real estate agency market for quite a while now, right? Firstly, the real estate agents themselves, because it's very, very big so-called ticket items, right? Selling a house, commission is a big sum, right? They do tend to be a bit more sensitive. The price elasticity is not as inelastic as you would assume compared to, say, doing, one of those like micro payments kind of lending companies, right? Because the amounts are much smaller. So every dollar that you move, percentage-wise, it could be a big difference. You know what I'm saying? It's a psychological thing, right? But for real estate agents, by default, it's a huge market, but it's also more lumpy, right? The numbers are a lot bigger. So that's why every percentage, let's put it that way, is actually a big sum in absolute terms, right? So what I'm saying is, it's not as inelastic as one would assume compared to many other markets, right? So that's where actually we have to strike the right balance, right, in our pricing. So because of that, some of the strategic decisions we're taking going to other markets do take that into consideration, right? Some of the announcements that we're hearing, as long as it fulfills the SAFE criteria, large addressable markets, right, that we'll be extending our services into. One natural path is insurance agents, given that Sumitomo Mitsui Group is our strategic investor. So we've been working closely with them to understand the insurance market better. So insurance agent is definitely a market that we are keen to expand into. And the good news is not all the ticket items are huge amounts, right? Because insurance is very varied in the kind of, there are a lot more, how do I say, they're less homogeneous, right? More heterogeneous compared to real estate agents in terms of the product offerings that they have, right? So that's something, but it also means that it's a bit more complicated. We have to understand the 150 to 200 products out there, but all of them will have a different collection time, default rates, breakage rates, whatever they call it, their loss ratios they call it. So that's something we need time to study and let our actual model take its natural course in regressing on that, so that before a single dollar goes out, you already know what is safe, what is not, right? Which segment to play in, which segment not to. Okay, so that is definitely one of the expansion plans, right? Then there's one or two more other industries that we're actually studying very closely, and we will have an unfair advantage in these industries because of the partners that we're going to be partnering up with, right? And these partners have very solid financial backing, and they're willing to support us to move into the industry in a safe way, right? And the name of the partner is coming soon.
Okay, collectively, many of us have put money into the Azure Light Fund, which then goes to Light. We want to know how much has been advanced since the inception in 2019.
Okay, so this is where I need to say a very big thank you for those of you who have been right here from the very beginning. These are the numbers that have transpired, right, when you first came in, right? Those who are coming in the middle, maybe you'll take part of it, but cumulatively we've already done about 300 to 500 million in advance, right, over since 2019. Right? But a lot of that was actually bunched up in the last 2 years because that's when it really took off, right? But in terms of what is more powerful actually is not just the commercial advance, it's how much money flows through our system that gives us the leverage, right, to actually build up that safety in numbers. So literally 300 to 500 million, but the total income that flowed through our platform is now more than $1 billion. So actually that has actually quantified us to be one of the top fintech companies in Singapore already, and still running at a 0% default rate. I think that's something we're very, very proud of. What we do ask is actually for your patience in the coming weeks. Let us wrap up a couple more deals first. We all know what's on your mind. We're always trying to expand our addressable market, right? And hopefully by that, we can also push harder in getting more yields at still a 0% default rate kind of level, right? So that's what we're trying to do.
Okay, but other than property right now, there's also, just to recap again, there's also Samsung that you're helping out with, right? The workers in Samsung. I think there's about 2,000 employees of Samsung, of which a good percentage is already on the system.
Correct. So the way it works here is that we don't have to wait till every single real estate agent is using us and then we go to look for other verticals. Because like I said, there's a natural process in how we onboard the agents. First, we start off with the lowest risk agents. Then after we go to the middle tier, and finally go to the highest risk, right? Now, when that is already in the process, right, which is exactly where we are today, we are the most furthest ahead with real estate agents. Samsung is a bit further behind because they came in later. Insurance agents will be next. So the job here is literally just keep finding new industries with all these freelancers, part-time workers, contract workers that are safe, right? And then start onboarding them sequentially, right?
We were talking about stable rates, right? We want to know in the second half of this year and into 2025, what's your outlook with regards to rates? Because you seem so excited about the new business that's going to come in. Is that going to impact the overall rates? Because I think that's what investors are concerned about.
Yes, so I think the hint I've already given, if you haven't caught it already, right, is that stability is the first anchor. So real estate definitely provides that stability. But the one that we want to accelerate into is industries potentially with higher rates. And that's the one that's actually coming in the coming weeks when I'm finally allowed to make the announcement. Right? Immediately, I think when you see my update, it will, a light bulb will turn on right away. Right? You'll immediately understand and get it, why these are the next industries that I'm penetrating into, besides real estate and insurance. Right? And more importantly, it is safe because of the way that it is set up. What I always like is tackling high, inverted comma, perceived high-risk industries, because that means no competition, right? If it's low risk to begin with, everyone will be in it already, right, including the banks. But it's always tackling high-risk perceived industries, right, that the banks either don't want to or don't dare to go in, but using that proprietary AI algorithm that are built up, right, to actually penetrate the industry in a safe way. Right? And that is why the strategic partners that's about to be backing us on this is equally excited with us. The main clue I can give is not only are the yields potentially a lot higher in this industry, but the addressable market is even bigger than real estate and insurance, right? Because this is one of those old school traditional industry in Singapore, there's a hint already, that is traditionally considered high risk, but we're very confident with their support, our partner support, we can actually de-risk it to almost zero. I don't want to overpromise it's complete zero, but that's what we're working towards.
Okay. Sounds exciting. Dennis, yes. Audrey.
So what's the higher interest rate that we can expect?
Okay, this one,
Let
right?
me-
I'll take it like as if you are the listed company CEO, because I'm not too sure whether you want to answer it right now, or do you
I
have
mean,
any-
okay, I can give a quick answer to that. So, to be honest, the PPM itself doesn't allow me to fix rates. Do you know what I'm saying? It doesn't allow me to promise rates because there is a discipline waterfall that it has to go through. Right? I cannot be telling you, oh, it's going to be this number, and then magically it's really that number. You know what I mean? Somehow there's a camera recording me. So what I'm saying is that it has to follow a due process, right? What I can say is we're working our hardest to generate whatever we can generate out of the business, and then we'll put it through the PPM, the whole waterfall thing, and then from there, the fund administrator will actually say what's the rate for the year. But having said that, it shouldn't vary too much from what we have seen in the past, right? Because it's still the same industry.
I think the
Where I'm a
last
bit
2 years
more-
was quite stable.
It was
right?
stable. Where I'm more confident to say something, but still without promising anything on rates, is that with these new industries that's coming in, it's almost certainly on an average basis, weighted average basis, higher. And that's the reason why I'm going to all these industries. Yeah.
I'm putting on the analyst cap right now, and it's not because Azure Light Fund is my own product, but you see with him telling us and hinting to us that the interest rates or the rates that they're going to offer in the next financial year will be better, and then over in the US, they are already like talking about the possibility of lowering of rates by September. Whatever it is, it's even if it's higher for longer, but at a certain point, we don't expect the interest rates in the US to go any bit higher. So the thing is, it should go south, while our rates will likely hit north. So I think it's really, really a good investment. Again, not because I'm managing this fund.
Okay, I think what's important is I'm not running away. I'll be hovering around, right? Please ask me what is the announcement that's coming, right? If you give me enough drinks, maybe I might accidentally say something. I can't remember. All right, so anyway, thank you very much for your...
Hey, thanks so much, man, Dennis.
attention. Thank you.
Dennis.